Hello everyone, welcome to this channel. I am Christoph Gall and this is
Scott Pearson.
and so Mr. Pearson is the Chief Investment Officer of Pearson Asset Management and also the President, and we're here to just give some insights on the market and talk about our firm. So just as a brief overview, could you share a little bit about the history of Pearson Asset Management?
I'll do my best.
Okay.
So our firm was founded in 1999 as Value View Financial Corp. And that emphasizes our interest in finding good values in the investing market. But I've been in the industry considerably longer than that. I started actually working in a firm that my father had begun back in the early 1990s. And worked with him for a number of years. He's since passed away. Towards the end of that decade, my brother joined the firm, and then I went off and founded my own firm. And since he's retired and closed down that business recently, we've decided to reclaim the family name and carry that legacy forward. And so this is why Value View is now rebranding as Pearson Asset Management at this juncture.
I see. Okay. Yeah, thank you for sharing that. What states have you worked in?
Well, we've worked with clients in a number of states and actually some foreign countries, but presently we are licensed to work in Ohio, in South Carolina, and of course our main operation is here in Florida.
And you're not just a money manager, we'll talk about it later, but you're also a teacher. So talk to me a little bit about that.
Well, sure. I teach at Palm Beach Atlantic University. I teach finance there and financial markets, investments, different things like that.
Okay, nice. And you teach there, and what universities have you gone to before?
I got my undergraduate at Samford University, my master's in business at University of South Florida, and then PhD at The Ohio State University.
Okay, nice. So you've studied like economics and finance pretty rigorously. That's good because it'll tie into my next question. So since you've studied like finance and the institutions really behind finance pretty rigorously, could you just talk a little bit about the differences between just like what a broker is, what a financial advisor is, what a money manager is, just briefly?
Well, so I guess some background there. When we got into the industry and started doing investment advising back in the 1990s, it was sort of a nascent industry, and pretty much the brokerage industry dominated everything back then. And so most people, when they did investing, they had to go to a stockbroker. They would pay commissions to the broker, and the brokers would make decisions or advise them in decisions. But those decisions might be a little bit biased since they would be earning commissions on each trade.
I see.
And so the investment advising world came about sort of in competition to that old brokerage model.
Okay.
And what investment advisors do is they manage usually on an assets under management basis, sometimes for a fee, but many firms offer investment management for 1% of assets under management per year.
Got it.
And in exchange for that, they try to manage the accounts since they are operating with fiduciary duty that the brokers don't have. They try to manage the accounts really in the best way they can to the client's best interests. And so they make the buy and sell decisions and help the clients to achieve the rate of return that they're striving for.
Nice. Okay. Well, that sounds pretty expensive to hire someone to do all that work. Could you talk about what that looks like on the?
Well, we have, like, one of the plans that we have is what we call the 1% plan that allows people to get started, and we just manage their money on the basis of 1% of assets under management. And depending upon the size of their account, we
Yeah.
can focus more and more of our attention on, the different aspects of money management. But it's not really that expensive to hire a good money manager. I always tell people the thing you should think about is whether or not somebody that you hire that has all of this expertise can outperform how well you could do managing it yourself by 1%. And I think if someone that can be trusted to outperform your own management by 1%, then it's probably worth it to give that up and let somebody else do it.
Yeah, and a lot of people would probably be hesitant just because, they're working jobs, maybe they're feeding their kids or they're spending money on education. And so their first couple of years, they might not feel that it's really worth putting that money aside. But you're saying it grows a lot, so it definitely is worth it.
That's really the challenge, and getting started early is absolutely essential. But it's difficult, and this is really, I think, a lot of people don't face up to this reality. There's never a time where it's just easy to put money aside for savings and for investing. When you're just getting started in life, there's all kinds of new expenses coming up. When you have kids, there's all kinds of expenses with that. And so there's never really a point at which it becomes easy. And unfortunately, I encounter a lot of people that get maybe to the age of 50 and they realize they haven't saved anything for retirement. And all of a sudden they have to start putting enormous sums aside to have something for their retirement. Whereas if they'd started at 20, they could have actually done it by putting relatively small amounts aside. It seems like it's really hard at that point, but what happens is that compounding effect really pays off over the long run. And so this is really the benefit of starting early.
Okay. So what do money managers mainly focus on? What's the...
There's many different things that they can focus on. I mean, I would say our focus is on two particular aspects of money management. That is looking at it from the point of view of value and growth. So I remember one of the things that Warren Buffett said. He said when Charlie Munger joined him in the well-known Berkshire Hathaway partnership, he said he learned something from Munger at that point, that it's not enough to just find good value.
Yeah.
But you have to find value in things that actually have significant future going forward. And so this is really where the balance is. We take value very seriously. This is the reason why we use the name Value View Financial Corp, which has been our name for the past 30 years. But the importance looking forward is, are you growth focused? Are you focused on doing something significant over the long term? So we can find something that's a great value, and that's an important factor. I don't want to be paying ridiculous prices for securities, but you want something that has good long-term potential so that you can invest in it and stay in it. One of the things that I think we've talked about before is the importance of compounding.
Yeah.
And, many people have said compound interest is a magical thing. It's a tremendous impact. And I think many people take it for granted. But what compounding really means is that not only are you earning, but you're earning on your earnings. So if you're able to earn, say, compound interest, if you earn maybe 8% in a year, and that 8% is reinvested, the next year you're going to be earning not just on your original investment, but also on the 8%. And that doesn't sound like a lot initially, but if you think about recoupling that time after time, year after year, over the long term, compounding has just a dramatic, almost exponential effect. And it really just tremendously improves results. So the key is really being able to maintain your investments and keep them invested over the longer term.
I see.
And then the results are almost magical.
Yeah, that was the last question that I had for you.
All right.
But just as a short thing, thank you for watching, and we hope that you guys will continue watching other videos that we have. And if you're interested or something stuck out to you, we have a website which will be linked below. So feel free to find us there or email us. And have a great rest of your guys' day. Bye.
Thank you.